Well, the time has finally arrived. We have Q2, the second earnings season of 2023, just starting this week. And it's going to be a busy one. We have all these companies giving us updates. And this is really, it's like you're just checking in on the company. You have the company give you commentary, what the thoughts are of the executives and the CEO. You have the company giving you a financial update with the economics of the company. You get the income statement, the balance sheet update, and you get the cash flow statement. So you can see financially how things are doing, as well as you get an earnings call where analysts can usually call in and ask the executives questions. So this is a big update. We get to see what's going on with all of these companies. Now, there's a lot of companies reporting earnings, but the ones that we see here are the biggest, most notable ones with the largest market caps. And what I've done is I've highlighted the ones in red that I think are the most notable, the ones that I want to go over today and give a prediction on, give my thoughts on. We have, first of all, tomorrow morning on Tuesday morning, before market open, Bank of America, one of the big four banks, and Charles Schwab. We'll be going over both of those. Then we skip past Tuesday to Wednesday before market open. We have Goldman Sachs and Ally Financial. These are more investment banks and brokerages. They're all in that fintech banking category. We'll be going over and looking at a little bit of all of them. And then, of course, we have the two big ones. The two big ones with the red logos there, Tesla and Netflix. Tesla is highly anticipated. One of the most watched earnings report, maybe the most watched earnings report of the entire season. And then we also have Netflix, which is also one of the ones that puts off the most fireworks. Netflix has traded up 15% after earnings. It's traded down 20% after earnings. It's crazy. What happens with Netflix is crazy. But I'll be giving some predictions and thoughts and context to each of these ones as well. Then we have IBM, we have American Airlines on Thursday, and then on Friday to close out the week, we have American Express. So we'll be going over all of these, but we'll be spending the most time on Tesla and Netflix. So we have a fun week to get into here, and next week I'm going to be doing the same thing, but next week is even busier, so make sure to tune in there as well. Now, some general thoughts before we even talk about individual companies. General thoughts on the stock market are, we are in a bull run. Year to date, the market's up 18.31%. This is a strong performance this year, and it was unexpected from a lot of people. We even have articles like this from the Wall Street Journal. The markets appear convinced. They're convinced now that the Fed can pull off the soft landing. The soft landing is taking down inflation without causing a recession. So markets are convinced that good events are now going to happen. We have a very bright future. Stock prices are going up. And when that happens, when stock prices continually go up, investors start to believe they'll go up forever. They come up with rationales and reasonings and justifications of why the markets will continue to go up forever. And it's the same thing with the other direction. When the market was going down in 2022, remember how many people right at the bottom were still convinced that we weren't there, that asset prices weren't good, that it was better to be in savings accounts, and the market was going to continue going down? That's the same thing that always happens. When markets go up, people think it will go up forever. When markets go down, people believe it will go down forever. Right now, the market's going up. So when I see that happen, I look at this earnings season and I look at the market and I just position myself a little bit more cautiously. Doesn't mean that I'm not in the market or that I'm bearish. I'm bullish on the market. But when everybody else starts to be incredibly bullish and push up asset prices, that's when you can get in trouble if you follow with the rest of the herd. So right now, I'm positioning myself a little bit more cautiously, a little bit more conservatively. Now, having said that, let's go ahead and take a look at some of these companies here. We'll start off at the beginning of the week. We have tomorrow morning, Bank of America, one of the big banks, reporting earnings, and we have Charles Schwab, an asset manager brokerage. So let's go ahead and just first look at Bank of America here. We'll bring it up on Qualtrim. This website, this whole tool is available as part of the Patreon membership, so you can try that out if you want. But Bank of America has not had a good year this year, and this is what you expect to see with large banks. They're highly cyclical, they're difficult to time. This is part of the reason why I decided to move out of asset managers, out of banks. I don't invest in these companies anymore. Because you may have had a good thesis back in 2018, but the price is the exact same. So you didn't make any gains since then. If you would have bought it during the COVID lows and sold during the recovery, of course you could have made a lot of money, but it's very difficult to gauge what these companies are going to do. And their balance sheets are incredibly complex. Now, we do have a notable investor that has this company as one of his top holdings. That is Warren Buffett. Warren Buffett has Bank of America, I believe, as maybe his second largest holding. It's a massive one. And a lot of investors might say, well, Joseph, if it's good enough for Warren Buffett, it's good enough for me. But that's not really the case. Warren Buffett got a special deal on Bank of America. If you study the history of when he bought the company, it was one of these phone call deals where he calls the CEO, he says that he's going to get these type of shares with these type of options on it, on a special pricing, because Bank of America was struggling during the financial collapse, during a scary economic time. So he got a preferential special deal because he manages billions of dollars that retail investors cannot get. So I would not use Buffett as a reason for owning this company. And in fact, Buffett has been a net seller of financials and asset managers over the past 5 years. He's just held on to Bank of America. That's why it's such a large holding. So we have Bank of America here. My prediction is I think the earnings are going to be good. And if you want to play this conservatively, I think the biggest banks will be the best bets. So we have Bank of America, and then we have other companies like JP Morgan. This would be the one that I would bet on if I was betting on bigger banks. JP Morgan is up this year. It's heavily diversified. It's very conservatively ran. It's too big to fail, frankly. The government can never let this company fail. So it's in that category where I think it's far less risky than the smaller banks. So Bank of America is reporting earnings. I think they're going to beat their expectations on both their earnings and revenue. They already passed the stress test. I think that's a good sign. In terms of what's implied in the price right now, the bank does trade at a price to book of 1.07. So investors don't have that high of expectations in this bank. There's not much baked into the price. Now, the next one that's reporting earnings tomorrow morning, which I think is even more interesting, is Charles Schwab. This is one where, remember the whole regional bank fallout, that whole crisis? This company was part of that. It didn't really have any trouble, but investors were still concerned about Charles Schwab. So you can see on the price chart here, the price went down about March, right? In the middle of March, it went down significantly from $75 to $50. And it really hasn't recovered all that much. So if you're an investor in Charles Schwab, you're basically believing that this drop right here wasn't justified. And you're buying the stock because you think that eventually it will go right back up to $80 per share because this drop wasn't justified in the first place. Now, I tend to believe with the investors that think that. I looked at what happened, and the companies that were really having trouble were the ones that had lots of leverage, not great balance sheets, and they're taking on huge loan losses. That's not the situation Charles Schwab was in. They had a stronger balance sheet, they were more conservative, and on top of that, the CEO of the company actually invested a lot of money into the stock. He started buying shares aggressively in a show that this isn't him just talking. He truly believes the company's undervalued. So when I put all of that together, the CEO really buying the company having a different balance sheet than all the regional banks, I tend to believe that it really was in no trouble. Not in the same trouble as these smaller regional banks that were over leveraged. So I don't have any problem with someone buying it here. I think the company will probably outperform. I think it will do well. Now, moving on from Tuesday, we go into Wednesday, which is the busiest day of the week. And we'll start off here with Goldman Sachs reporting Wednesday morning. My prediction here is, and again, I can't see the future. This could be wrong, but my prediction is they're going to beat. They're going to outperform by a pretty wide margin. Why do I say that? Well, first of all, I believe that every financial company so far is going to have decent earnings. I think Charles Schwab, Morgan Stanley, Bank of America, I think JP Morgan will as well. I think they're going to have decent earnings because people have been the economy has been going well. Banks are a reflection of their balance sheet, of the extension of their loans. If people are repaying the loans and paying interest, banks' earnings do well. So Goldman Sachs is partly a bank. That's part of their company. But they're also a credit card issuer, and I believe there's been lots of credit card spend. They're also a trading floor. Now, in terms of the trading floor, that's another part of their business that I've noticed over time, a correlation that whenever equities are doing well, whenever the markets are excited, whenever we see articles like things can't get any better, that's when Goldman Sachs really does well with their trading floor. So I would expect to see very good trading profits with Goldman Sachs. And I think that will lead to extra outperformance. Now, of course, I don't know for sure, but that would be my expectation. Now, let's go ahead and take a look at Ally Financial that's also reporting earnings Wednesday morning. This one's a tougher one for me. I think Ally Financial is more risky than the other banks. And the reason why is because this company ultimately reflects the balance sheet and the extension of their loans, which are mostly cars. Now, if we look at cars generally, and especially used cars, have the prices been going up or the prices been going down? I believe they've been going down. Across the board, most used cars have been having their prices slashed. That's tough for Ally Financial when they're the ones issuing all of these loans. The value of the asset, the collateral that they're issuing loans for, has gone down in value faster than expectations, faster than what's normal with cars. So when it has exposure specifically to the auto industry, I think that makes it more tricky, more risky. There's a chance it could outperform because, again, everything seems to be going well right now with financials, but I would not bet on this one. I think that there's too much of a chance of the margins going lower, too many defaults, or too many issues like that. So in terms of Ally Financial, this is not one that I'd be betting on myself. So overall, I think these financial companies are going to do well. They are ultimately a reflection of the loans they give out and of their balance sheets. That's what a bank really is. And in terms of my concerns, I think the one that's the most risky is Ally Financial. Now we move on to the biggest, most exciting ones of the week. We have Tesla and Netflix. Let's go ahead and start off with Tesla. Now, I don't currently own any Tesla stock, and I know that's shocking to a lot of people because I own a lot of cutting edge technology companies. I own the Googles and Microsofts and Apples, but I don't own Tesla. So why is there a difference there? Well, let me go through a couple of the concerns that I have. The first concern I have with Tesla right now is it has exceedingly high expectations already baked into the price. So investors are pricing this company not as a car company. It's not a car company based on its pricing. It trades at multiples of what car companies trade at. For example, if I brought up Ford, it would be like a 7 to 10 PE ratio. This trades at a 28. So this is being priced more in the range of a company like Apple. If we bring up Apple, this one's trading at a 25. Tesla trades at a higher multiple. But Apple also trades at a 3% free cash flow yield. And Tesla right now, based on the past 4 quarters, trades at a 0.47, which again that doesn't mean that it's necessarily overvalued. It just means that there's high expectations, very high expectations in the company. And when you have very high expectations priced into a stock, to still own it and buy it at that point in time, you have to have exceedingly high confidence that it's going to live up to those expectations, that it's going to surpass what investors are expecting right now. That takes a level of confidence that I just don't have in the company. Some investors do. They have a bet that it's going to exceed these high expectations. It's going to become a massive ecosystem of products and have incredibly good economics. But I see a lot of variables there that haven't played out, and I see a lot of risk there. So the expectations right now for Tesla simply don't match my level of confidence. That's the reason that I don't own it. Now, so far, Tesla has been hitting those high marks. They've been exceeding people's expectations. That's why people have such high expectations for it right now. The company's revenue has grown consistently above investors' expectations. We have the free cash flow of the company having a parabolic spike over the past couple of years, moving from the negative with their big CapEx investments heavily into the positive as they now have scalability. And then the earnings per share shows the same thing. You can see the big spike there over the past couple of quarters. Their estimates are going to be 81 cents this quarter, which is right around there. So in line with the past 5 or 6 quarters, around that same amount, which I think that they can hit. I think that Tesla will do good with most of their metrics. The one that I'm the most concerned about, if I had a list of concern, the margins are always the concern when I'm dealing with Tesla. The reason why is I look at the margins of any company in the auto industry, and they're not pretty. Tesla's it's the one pretty one and a lot of ugly companies there. So Tesla has had pretty good margins for an auto company, and that's because they have the scalability, they have the better manufacturing. But the question is, can they continue to keep this up? Over the past couple of years, we've had a really odd dynamic in the economy with cars. We had prices going up for used vehicles, and that's not normal. So when things normalize, what will the margins look like? I don't know. And that's where I get concerned. I've seen the margins over the past couple of quarters. The operating margin went from 19% to 14.6% to 17% to 16%, and then down to 11.4%. Tesla has been lowering prices, but they're also selling more vehicles than ever. So in summary with Tesla, I think the earnings report will likely be fine. I think the biggest question for me is going to be the margins with all the price cuts. And a lot of that is reflected by different input costs as well. They have a lot of commodity costs and battery costs and things like that as well that will affect their margins. So there's a lot of things that Tesla can control. There's some things they can't control. Overall, my summary of this company is I think it's a good company. I just don't like the industry that it participates in, and I don't like the exceedingly high expectations that are already baked into the price. For me, it just seems a little too risky to buy. So Tesla's is going to be an exciting one. I look forward to that one on Wednesday. And then next up, we have another big one, Netflix. Netflix is a company that I do have an investment in. So I'm invested in the company, slightly in the green right now. That's because I held on to it and I actually invested a lot more when it started to trade down in its huge dip. It recovered well over 130%, and now we're back to $450 per share. So it's really recovered. It's not back to its all-time highs. For me, I'm very bullish on Netflix long term. I'm very bullish on this company, the industry, the economics of it. I view Netflix thesis very simply. I view it as the company that's the dominant global streaming winner and the inevitable winner of this industry over the long term. And the reason I believe that is because they're already in a position to offer consumers the best value for the amount of content and the monthly price. And they can continually use that leverage they have of their value proposition to grow into different markets and different demographics. And then on top of that, Netflix is one of these companies where I'm always looking for long runways of growth, years into decades. And Netflix provides that because as economies grow across the world, they're going to have more cable and high-speed internet, more users that are potential customers of Netflix. So every day, there's more potential customers for Netflix than the previous day. So I have an overall thesis on this company, an investment in it, and I don't look at it quarter by quarter to decide whether or not I'd buy or sell the company. But we do get an important update. This quarter, the big question, the big thing investors are going to ask about is whether or not the password crackdown is working. Obviously, with the price going up as much as it has this year, if we look at just the year to date, it's up 53%. And that is because we've had analysis. Third-party analytic websites say that the password crackdown is going really well. But that is simply third-party analysis. Netflix themselves have not confirmed anything about the password crackdown. So that's going to be the big question. How is the password crackdown going? Is it working well? Is it causing people to churn and leave the company for good? Are they coming back? There's going to be lots of questions around that. My opinion is that's going to be happy news. I think that it's going to be going as planned. I've reviewed the math on it, and I've actually released a video where I go over the odds of people canceling and never going back. And I think the math is heavily in Netflix's favor. The other big question is going to be the advertising version of Netflix. What percentage of new users are signing up for advertising? Disney just announced that around 40% of the new people signing up for Disney Plus are signing up for the ad tier. Is that similar to Netflix? I'd like to know. So we have two big catalysts for this company, the password crackdown and the ad tier. And then we just have the ongoing growth of the company. They're expecting revenue to grow ever so slightly, a little bit over $8.2 billion. And they're expecting the free cash flow. I don't know the exact expectation for this next quarter, but they're expecting a total of $3.5 billion in 2023. So the total for the year, they expect over $3.5 billion. So far, they have $2.12 billion this year with the first quarter. So they just have to make up for another $1.5 billion in the next 3 quarters. I think they're going to exceed it. Netflix is in a situation where they have that incredible operating leverage. They can control how much money they spend on content. It's very predictable in my opinion. So I think they're going to exceed the $3.5 billion. Another potential concern is something that's going to be brought up on Netflix's earnings call is the writers and actors strike that are both happening simultaneously. This is going to impact the company, and it's going to impact it in a bad way. But Netflix is going to talk about this on the earnings call. They'll say how they don't want it to happen, how they want to work with all the people that are involved in this and they see the value. They're going to talk about how it's not good for them, it's not good for their business. What they won't say, what the executives are not going to say on the earnings call, but what is the truth, is that Netflix is far better positioned to deal with this writer strike and the actor strike than most other media companies. They're better positioned than Disney. They're better positioned than HBO because they have a massive pipeline of content that's already made. Netflix can last a year with the content pipeline they have without needing to produce new content. So after a year, they'd actually have their content start to go stale. But that's a long period of time to strike, and the strike is likely not going to last that long. So this should not affect Netflix to any degree like a lot of other smaller content companies. So I think they have an advantageous position in this strike. I think they also have an advantageous position with their scale right now and with the profitability. Overall, I still remain bullish on Netflix. Now, if one of the metrics comes in a little short, if they have a little bit higher churn this quarter and the stock drops 10%, that's not a big deal to me. It's up 130% in the past year. So I'm not going to be concerned if we see a little bit of red after earnings. I've dealt with that a lot with Netflix. The most important thing is the long-term thesis of it, and I believe that that is intact right now. But I very much look forward to Netflix's earnings. I'm going to be doing a review later in the week when I have time to listen to the earnings call and read the report. Now, next up, we have IBM reporting earnings the same day. This is one where I was actually looking at these ones. IBM and Oracle and the legacy tech players. These are the former big winners. They're like the previous generation's big tech. IBM's a company that I've never been bullish on. As far as I've ever lived, I've never been bullish on this company. And part of the reason is I don't really understand what they even do. And that's someone that has worked in tech for around 8 years. I've looked at the company and I've read through what they do, but a lot of it seems like legacy agreements, lots of consulting and contracts, not things that are very present in today's age. I've favored companies like Salesforce. I think this is a terrific company right now. It has some problems with management, but overall it has very relevant software that's being used by lots of new companies that are starting up today. I favored companies like Apple. I favored companies like Microsoft. I favored a lot of other companies over IBM because I just don't feel that IBM is creating the most relevant products of the day. And the returns have shown that for a long period of time. Over 5 years, it's down 7%. Over 10 years, it's down 32%. The company is in this situation of trying to evolve and change a core business model. It has some self-cannibalization in the process, and it has lots of new competitors that have really better business models taking their market share. So that's a tough situation to be in. So IBM's not a company that I'm bullish on. And I'm sorry if you're one of the investors that's in this company. A lot of dividend investors especially get drawn into it because of the high yield. They're around 5% dividend yield. That has not been enough to justify this investment. And when I look at it, I see a substantial opportunity cost. There's simply better options. When you have companies like Adobe and Microsoft, why choose IBM? That's my thought. So I'm not really bullish on IBM right now. The earnings report could be okay. They might be expectations, but that doesn't change the fundamental investment thesis and the intrinsic value of the company substantially. Now, after IBM, we have American Airlines, another airline company. My thoughts on these are applicable to basically every airline company because their economics are so similar. Let's go ahead and bring up American Airlines here. The stock is actually having a great year. It's up 43%. Look at that. It's beating a lot of the other companies in the market. Does that mean that you should invest in the company? Not really. We look over the past 5 years and it's down 52%. We look in the past 10 years and it's had 1% returns. Since 2013, it's had 1% returns. And that's not really a surprise. That's not much of a shock that over the past 10 years, this company's given really no returns. That is the economics of airlines. You see, a company grows revenue, but revenue growth in and of itself is neither good nor bad. It can be good in some situations if the company's profitable, if it has high returns on capital employed, or it can be bad if they have lower returns on capital employed than the cost of capital. So if I was to take a loan out from a bank for $1 million that had a 10% interest rate, and I started a business and I grew revenue, but my returns on that revenue was only 5%, I would be losing 5%. That's how much money I'd be losing. And the more money I take from the bank, the more value I destroy. So revenue growth for a company that loses money can actually be a very bad thing. Revenue growth for a company that makes money on its capital above the cost of capital is a very good thing. So when we bring up the returns on capital employed for the airlines like American Airlines, they all show this similar chart. Now we can assume the cost of capital is somewhere around 10%. So the red line is the cost of capital. They need to earn above that amount to actually generate wealth. All these other quarters, all these other years are below that amount. So all these years, they're wasting money, burning money. All these years, they're burning money. And the most recent years, they're burning money. These couple of years here, they made money. This one here, they made money. This one here. So it's this highly cyclical, unpredictable business where overall, they're actually destroying investors' wealth. And this is why we can look back since the history of this business, and when we look at the returns of this company all time, since 2005, it has generated no wealth for the investor. The returns reflect that. It's at the very same starting point. In fact, it's down 6%. So we have a company here that really has given no returns, despite the fact that it has growing revenues, because it just does not have high enough returns on the capital. So for that reason, I'd never invest in a company like this. I avoid airlines. I'm not going to be investing in them unless there's some substantial dynamic change in the business model. But the business models for these companies are incredibly bad. They have high fixed expenses where if demand goes down, they can't wind down their expenses to match demand. So there's no scalability and flexibility in their expenses. Likewise, if they have an increase in demand, they can't scale up to match the increase in demand. They have high fixed expenses with their employees and pilots, which age every single year, and they have to pay a greater amount. They also have to pay retirements and a lot of liability. They have a lot of problems that these companies face. So they're not attractive investments, in my opinion, at all. I'm going to be avoiding them for that reason. But a lot of people will jump in. They'll jump in to try to get the next dip and have a nice gain in it. I'm not doing that game. So I think that American Airlines this quarter might be okay. They have a lot of demand right now, so it should be decent. But this is one where if you're investing in it, you have to treat it like a trade. You have to play hot potato and jump in and out, and that's not the game that I'm playing. Now, to close out the week, we have American Express. This is one of the longest held holdings of Warren Buffett's portfolio, and a company that's given incredible excess returns over the market. This is part of the reason Buffett has those crazy percentage gains, is because of companies like American Express. Now, this company is a tech company. It's a tech company that's also a little bit of a financial company. I think it should be looked at more from investors because it's very synonymous to Visa and MasterCard. I'm invested in MasterCard. I avoided American Express only because I liked the aspect of the payment rails more than the other parts of the business. American Express lends money. They have a whole ecosystem that they do. They're not just a payment company. But overall, I think that American Express is a very good company. I think it's top notch. And I believe that this earnings report coming up is going to be good. Like the rest of these financial companies, the more there's economic activity, the more people are able to pay back their loans, the more that they're willing to spend on credit cards. That's all a good thing for these companies' earnings. And over the past 3 months, I imagine that American Express has had a very good amount of spend, very good amount of loan paybacks. So I believe that American Express will beat on its earnings and revenue expectations this quarter. I think over the past 3 months, the economy has been strong enough. People have jobs, they're paying back loans, they're spending on credit cards. That's all good news for American Express. And that will close out this week's earnings. So we're going to have some follow-up. Make sure to subscribe to the channel with the bell icon. And I'll do follow-ups on Netflix and Tesla later in the week. So you can be looking at that. But that's all for now. See you in the next one.